Hi, I'm Nancy Deichman from Remax Premier Realty, and I'm sitting here today with Gary Schick from Landmark Mortgage. Gary is so experienced in the mortgage market, and we've got a lot of controversy going on, and we just wanted to tell you the real truth today about what's going on in the mortgage market with the new Robin Hood type theory of charging the good customers more for their mortgages so that the not so good customers can afford to get mortgages and better rates. Hi Gary, how are you today?
Good, Nancy.
Good, thanks you for joining me today on my Facebook Live.
You're welcome, I'm happy to be here.
Yeah, well you did such a good job of explaining all of this to our agents in our meetings, and I wanted everybody who's listening to find out this good news that you've got for us too.
Great.
Okay.
Well, I'm happy to share this with you, and what I have here is a little chart that shows where the interest rates have changed based on Fannie Mae and Freddie Mac's recent announcement regarding risk-based pricing.
That's what they call it, risk-based pricing.
This is what they call risk-based pricing. And what Fannie and Freddie are doing basically is they're making it more affordable for first-time home buyers to purchase real estate by giving them slightly better rates. So the hope is that that's going to improve their ability to qualify for homes. And the news has really grabbed onto this because there's a lot of controversy that people with good credit are getting penalized.
Right, that's what it feels like.
And it's interesting because when you look at this chart and see the impact on people, what's happening is people with very good rates and a good down payment really aren't being penalized. There are some categories of borrower that have good credit who are putting less than 20% down that are being penalized, but it's not really something that would make a huge difference in their qualifying.
So what does that mean in the difference of a monthly payment to them? Is it like how much, like on $100,000, how much is it going to change their payment?
Typically, as an example, if someone were putting less than 20% down, excuse me, and they had falling into this category where they're being penalized by Fannie and Freddie, it probably would translate into maybe 1/4 to 0.5% higher rate. And on $100,000, it might be $20 to $30 a month, roughly.
Okay.
But in the grand scheme of things, that really, I don't think, would prevent people with good credit from qualifying for a loan, typically. And the thing that the news hasn't really discussed is that there actually are some situations where people with very good credit and a good down payment are actually getting a slightly better rate. So it's not something where I would classify it as taking everything from the people with good credit and giving it to the people with bad credit. They're actually improving some rates for people with very good credit, with a good down payment. There is a certain category of borrowers who are putting less than 20% down that are getting a slightly higher rate. First-time home buyers with lower credit scores are getting better rates. But in general, when you look at this, people with excellent credit, good credit, are still getting better rates than people with lower credit.
Okay, so we're still getting the better rates.
Right.
And so but if somebody really doesn't want to pay for it, how can they avoid it? They're buying a house, they're getting a mortgage. How do they escape paying this slight penalty?
Well, there are various strategies, and one of them could be a shorter term loan, like a 15-year fixed.
Okay, so that's not going to be penalized.
That is not going to be penalized from what I understand. They could go with a 20-year fixed to get a slightly better rate. So if they're really, truly rate focused, they could get a shorter term and get a better rate.
And those are usually better rates anyway, aren't they?
They are, absolutely.
And so what about if they put more than 20% down?
They could put more than 20% down and they wouldn't be penalized. They would have the same rate that they might have had before these changes. So they could put more money down. In this chart, as an example, somebody with a 780 credit score with 30% down could even get a slightly better rate.
Okay.
So, more down, a shorter term.
Yeah.
There are some strategies that you can kind of work around this.
Yeah. So the news media has blown it out of proportion, I would say.
They have.
And I've tried to watch all news channels because different news channels give different slants on it, and for obvious reasons. But also, when it comes right down to it, isn't FHA a better deal for a first-time buyer anyway?
FHA has not been impacted by these rules.
No, because it's Fannie and Freddie rules.
That's exactly right.
Right.
So when the news is talking about this controversy, it's conventional loans.
Right.
And FHA is still the same. There have been no changes. And typically someone with a 700 credit score or under would get a better deal with FHA anyway.
Right.
And FHA just lowered the mortgage insurance premiums by just about half.
Wow.
So it's an even better deal now, and that's something to look at if someone has a slightly lower credit score.
Yeah, and the mortgage insurance premiums have always been a little high to me on FHA.
They have.
So now they've cut those in half. When I was reading this morning that like on a $300,000 loan, for an existing owner on an FHA mortgage and for a new buyer, it's going to save them about $900 a year.
That's exactly right.
Right.
That's
So
exactly
it's
right.
actually as good as or better than if they went with a Fannie or Freddie loan, a conventional loan, with less down.
It is.
So FHA is a better way. We've already had a program for the first-time home buyers. We've got USDA and we've got FHA.
We do.
They really didn't need Fannie and Freddie.
Well,
to kick in.
and that's true. And what we would do is look at the different loan programs and advise which would be a better path for
Right.
borrowers to go, whether FHA or USDA, but those have not changed.
Yeah, and then the credit score can be lower for FHA
It can be.
and for VA.
FHA will allow down to a 580 credit score,
Wow.
and VA the same. So they're more liberal in terms of their acceptance of lower credit scores, which is great.
What about the debt ratios on the FHA and VA versus the Fannie and Freddie?
FHA and VA will allow much higher debt ratios as well.
Right. So in essence, it's probably 5 times to 10 times easier for a first-time home buyer to go FHA or VA.
Typically it is.
Yeah, much
Typically it
easier.
is.
So forget about Fannie and Freddie for first-time home buyers. Let's go FHA with those guys.
Right.
And if we're conventional, let's put more than 20% down or get a 15 or 20-year fix and avoid that and avoid all this silly controversy that's taking up our news reports every day.
It is.
And
It's
taking up people's time and messing up their thought process about buying or selling a home.
It is. It
Yeah.
is.
It's
It's
a-
been very distracting for a lot of people.
Yeah, it has been totally distracting. So let's get back on target so we can help people buy and sell their homes, right?
I agree.
Yeah. So what are the conventional rates handling right now? What are we saying they're at right now?
Right now, interest rates are stabilized in the mid 6% range,
Mid 6%.
6.5%, which historically, if you looked at rates over the last 20, 30 years,
Right.
that would be about average.
Okay. What if somebody was to go with a 15-year instead of a 30? How much does that take off?
You'd be looking at just under 6% typically,
Okay, so
about
in the fives.
5.875.
One in the 5s, get a 15-year.
Yeah,
There you
that's
go.
exactly right.
All right. And also put more money down and
Yes.
have less of a payment.
That's right.
Okay. So our market is still brisk here in Central Florida. I know that there's different scenarios across the nation as far as what the real estate markets are doing. I can tell you right now in Central Florida, we have a great buyer and seller market. It is a good time to sell. It is a good time to buy. And if you're worried about mortgage rates, I would suggest that you call. If you want this chart, call Gary Schick at Landmark Mortgage. Gary, what's your phone number?
My cell phone number is 352-267-5177.
Okay. And what's your email address?
It's Gary at lmploans.com.
Okay, and I'm Nancy Deichman from Remax.com. If you'd like to reach me, my phone number is 352-427-5704, and my email address is nancydeichman@gmail.com. Thanks for joining.